The Federal Reserve just sent a secret message to Wall Street, and today I'm going to translate it for you. While the mainstream news was busy chasing other headlines, the Fed quietly admitted that the economy is on much thinner ice than they've been letting on. For years, they've been telling us the job market was a rock solid pillar holding everything up, but behind the closed doors of their September meeting, they finally let the mask slip. That pillar is cracking. This isn't just a small change in talking points, it's a complete 180. For the first time since December 2024, they cut interest rates, a move they only pull when they see serious trouble on the horizon. They're signaling that a massive shift is underway, one that points to a weaker economy and a shakier job market than most people realize. Their next move could have a major impact on your savings, your investments, your mortgage, and even your job security. I'm breaking down their secret message and what it means for your money before that next big move happens. So, what is the Fed so spooked? They just did something they haven't done in years, and it's a huge red flag for the economy. After a long and aggressive campaign of hiking interest rates to fight inflation, they suddenly slammed the brakes and reversed course. In September, they cut the federal funds rate by 25 basis points, bringing it down to a range of 4.0% to 4.25%. Now, a quarter of a point might not sound like much, but in the world of central banking, that's a seismic event. It's a clear admission that the old strategy is dead. The singular mission to crush inflation at all costs has been tossed aside for a new, more urgent priority, preventing the job market from falling off a cliff. This pivot was driven by a quiet admission buried in the data that the labor market is far weaker than they've been telling us. The risks to your job are rising, and the Fed just showed its hand. To understand just how big this shift is, you have to remember the old story. For the better part of 2 years, the message from Jerome Powell and the Fed was simple. Inflation is public enemy number one. They promised to do whatever it takes to wrestle it back down to 2%, even if it meant causing some economic pain. They raised interest rates at a blistering pace, making it more expensive for everyone to borrow money. Their justification was always the strong and resilient labor market. They swore the job market could take the hit. Well, that story just fell apart. This rate cut marks the death of that narrative. Let's break down the evidence that reveals what's really going on. First, the rate cut itself. As I mentioned, the Fed cut rates by 0.25% in September. Fed Chair Jerome Powell tried to play it cool, calling it a risk management cut. But let's be real, you don't take out an insurance policy unless you see a storm brewing. And that storm is the labor market. In his own press conference, Powell admitted that new data suggests there is meaningful downside risk to the labor market. That's Fed speak for we're worried people are about to start losing their jobs in droves. This brings us to the real bombshell, the job market data. The official numbers are now showing profound weakness. Job growth has slowed to a crawl. The latest ADP report, for instance, showed that private employment actually declined by 32,000 in September. The days of adding hundreds of thousands of jobs a month are a distant memory. The unemployment rate has ticked up to 4.3%, the highest it's been since late 2021. Some Fed members are now openly worrying they're already behind the curve in dealing with a deteriorating labor market. In other words, they're afraid they've already waited too long to act. And here's the part that feels like a betrayal. There's mounting evidence that the job numbers were being puffed up for months. A recent benchmark revision from the Bureau of Labor Statistics revealed that job growth between March 2024 and March 2025 was overestimated by a whopping 911,000 jobs. The strong labor market we heard about for so long wasn't nearly as strong as they claimed. It was a mirage, and the Fed has finally been forced to confront reality. The third piece of this puzzle is inflation. You'd think that with the economy slowing this dramatically, inflation would be cratering, but it's not. It remains stubbornly high or sticky, hovering around 2.9%. So here's the Fed's terrifying dilemma. They're caught between a rock and a hard place. If they cut rates too fast to save jobs, they risk letting inflation get stuck above their target or even reigniting it. But if they keep rates high to fight inflation, they risk sending unemployment soaring. They chose to pivot toward protecting jobs, and that decision tells you exactly what they're most afraid of right now. So, what does this actually mean for the economy? It means we're walking a very dangerous tightrope with no safety net. Think of the US economy as a massive cargo ship. For 2 years, the Fed was trying to slow it down. Now, they've realized they may have slowed it down too much, and the engines are sputtering just as they see storm clouds on the horizon. The official debate inside the Fed is how fast to get those engines going again without breaking them. The September rate cut vote was 11-1. But that one dissenter argued for a much bigger 50 basis point cut. He's worried the ship is already dead in the water and wants to act more aggressively. This division just highlights the immense uncertainty they're facing. This isn't just a US problem either. Economic growth is slowing down all over the world, and other central banks are also cutting rates. This global slowdown puts even more pressure on the US and confirms the Fed's newfound fears. Now, here is the paradox that confuses so many people. If the economy is so fragile, why is the stock market hovering near record highs? The answer is a little twisted. Wall Street has been trained to believe that bad news for the economy is good news for the stock market. Why? Because bad economic news means the Fed will step in with its ultimate painkiller, lower interest rates and cheap money. Investors aren't celebrating a weak job market, they're celebrating the Fed's reaction to it. They're betting this September rate cut is just the beginning. In fact, major banks like JP Morgan are now forecasting two more rate cuts in 2025 and another in 2026. The market is buying up stocks in anticipation of a flood of cheaper money that will push asset prices even higher. But this creates a very dangerous situation. The market is rising because the underlying economic fundamentals are getting worse. That's a party happening on a very shaky foundation. If this breakdown is helping you see the hidden message the Fed is sending, do me a quick favor and hit that subscribe button and the notification bell. The economic landscape is shifting fast, and my job is to translate these complex events into clear, actionable information so you can stay ahead of the curve and protect your money. Your support helps me keep doing that. So, why does any of this matter to you? Because all this high level Fed talk directly hits your wallet. Let's translate this massive shift into a personal finance playbook. First, your job. The era of the great resignation, of easily jumping to a better paying job, is over. The power is shifting back to employers. With job growth stalling and unemployment ticking up, job security is a real concern again. Polls show that most Americans now believe it would be difficult to find a good job if they were looking. This means your leverage in salary negotiations might be weaker. More importantly, the value of a robust emergency fund, I'm talking 6 to 12 months of living expenses, has just skyrocketed. In a shaky job market, cash is king. Second, your savings and your debt. The Fed's rate cut is a double-edged sword. For savers, the party is winding down. Those amazing 5% plus rates on high-yield savings accounts are likely going to start drifting downward. If you've been enjoying those returns, be prepared for them to slowly shrink. For borrowers, the news is a little better. Variable rate debt, especially credit cards, should get slightly cheaper. But we're talking about a small drop from a very high level. This is a small window of opportunity to pay down that debt more aggressively, not an excuse to take on more. For mortgages, the picture is cloudy. Long-term rates are expected to stay somewhat elevated, so don't expect a return to the rock bottom rates of a few years ago. Finally, and most importantly, what about your investments? This is where the Fed's pivot creates both huge opportunity and huge risk. First, stocks. In the short term, the market's first reaction is probably right. Rate cuts are like a tailwind for stocks. Lower rates make stocks look more attractive compared to lower yielding bonds. The expectation of more cuts could keep supporting prices. But you have to look past this initial sugar rush. You're investing in a market that's cheering for a weak economy. That's a contradiction that can't last forever. Strong corporate earnings have kept things afloat, but if the job market keeps getting worse, consumer spending will fall, and those earnings will eventually take a hit. This is a time for cautious optimism, at best. Next, let's talk bonds. This is the asset class many people ignore, and it's where the smart money prepares for uncertainty. When the Fed cuts interest rates, the prices of existing bonds with higher yields go up. As the economy slows, high-quality government and corporate bonds can provide a crucial safe harbor for your portfolio. In a world where the Fed is admitting things are getting shaky, owning some high-quality bonds isn't just for retirees anymore. It's a vital part of a balanced strategy. This all leads to the most important advice in this environment: diversification. When the Fed itself is divided and uncertain, the last thing you want to do is put all your eggs in one basket. A well-diversified portfolio across different asset classes, stocks, bonds, maybe some real assets, is the single best way to protect yourself from risk and be ready to capitalize on whatever comes next. Beyond the immediate data, there's another massive change happening in the background that complicates everything: the rise of artificial intelligence. The AI investment boom is one of the main reasons the stock market has stayed so strong. It's a powerful engine of productivity, but AI's impact on jobs is a huge and unsettling question mark. Polls show Americans are deeply suspicious of AI, with many believing it will ultimately kill more jobs than it creates. So the Fed faces a puzzle. Is AI a force that will boost productivity so much that it keeps inflation down, giving them more room to cut rates? Or will it displace workers so quickly that it throws gasoline on the smoldering fire of the job market, forcing them to act even more aggressively? They aren't just navigating a normal economic cycle, they're trying to land the plane in the middle of a technological revolution. There's one more stealth force at play: quantitative tightening. While everyone is focused on rate cuts, the Fed is still quietly shrinking its massive balance sheet. This is another form of monetary tightening. It's pulling money out of the financial system. So the Fed is in the bizarre position of hitting the accelerator with rate cuts while still gently tapping the brakes with its balance sheet. This contradictory policy shows that even they aren't sure which way to go. So, what's the bottom line here? The Federal Reserve's quiet admission of a weaker economy is a game changer. The era of fighting inflation at all costs is over. The new game is about managing a slowdown without causing a crash, all while inflation remains uncomfortably high. The market is celebrating the return of rate cuts, but it's critical to remember why those cuts are happening. They are a response to cracks forming in the foundation of the economy. Specifically in the job market, we were told was indestructible. This is the core tension you need to understand. The market is cheering for the medicine, but the medicine is being prescribed because the patient is sick. As an investor and a consumer, you can't afford to be complacent. You need a plan that prepares you for more uncertainty, for a weaker job market, and for a Fed that is clearly more worried than it's letting on. The secret message has been sent. The question is, what will you do about it? What are you doing to prepare your finances for this shift? Let me know your strategy in the comments below. Let's navigate this together.